All right, guys, I'm Big Mike. Like always, I want to thank you for being here today. Today we've got FuturesTrader71. For those of you that don't know who that is, he is a very well-known, very well-respected professional trader. He's got over 10,000 followers on Twitter. He's famous for volume profile, and that's what he's going to be talking about today, as well as a few other things. Basically, he's got an outline that he's going to cover who he is. He's going to go over yesterday's charts, and he also wants to talk a bit about the typical struggling trader. And he has several bullets to talk about, including the minimum commitment from you in order to be successful. There is going to be a Q&A. I want to remind everybody of a few things. First of all, the webinar is being recorded. So either late tomorrow or Monday, I will post the recording on the website. You can go to bigmiketrading.com, click webinars from the top of any page, and you'll see it there once it's posted. I will also email it to FT71, and he can send everybody the link to that. The second thing is, as you guys have questions, just type them into the box. Keep in mind that only myself, FT71, and Anthony can see the questions. You won't be able to see each other's questions. So you'll need to either watch the screen for Anthony to answer or listen for FT71 to answer. All right, guys, hang on one second, and I'll give it over to FT71.
Good morning, everyone. Can I get a mic check? Let's see. Okay. So thanks for taking time off your weekend to come in and listen to this. Thanks to Big Mike and his crew for inviting me to come in and talk. We have a pretty structured presentation here. I'm going to start with an introduction. We're going to talk about something that I use very heavily to trade with, and we're going to start out with some history, and we're going to try to push through that fairly quickly. I doubt you'll be all that interested in my history, but it helps qualify who I am and why I'm doing this. So let's go ahead and move forward. Volume profiling, looking inside the bar. Since I became a registered broker about a year ago, you know, there are regulations I have to comply with, so I need to make sure that everyone hears this disclaimer. You need to know that derivative transactions, including futures, are complex and carry a risk of substantial losses, are not suited for all investors. Futures are leveraged, so you can lose more than the value of your initial investment. The information shared here during this presentation is for educational purposes only. It is not intended for use as trading or investment advice. Past performance is not indicative of future results. Who am I? I started out as an equities trader. I traded for what's called, with a group that's called the SOS Bandits through a company called the Holt Brothers. I started down in Florida. Quit my normal day job and joined a crew and put up I think it was about $45,000 or $50,000 and started to try to learn to trade equities at high speed, mostly scalping momentum on stocks like JDSU, Dell, Microsoft, and so forth. It wasn't I had just started turning the corner when 9/11 hit. And before that, some changes occurred on the NASDAQ exchange that we were trading on. And this is the first time that any old person can have direct access to a level 2 screen and trade live and in real time, just like a bank or a mutual fund could. So we got in there and we would front run orders, very large orders, by various funds and entities, banks, and so forth. And you know, some of the guys I traded with did really well, but then learning to trade that way is also conducive to losing very quickly, because you don't actually learn the important aspect of risk management and so forth. Once that game dried up because of decimalization and fees and regulation and so forth, I had an opportunity through a friend to come up to Chicago from Florida. I think I got a call on a Thursday, and I was told that there's some proprietary trading positions. Proprietary trading means a firm sets up a fund or its own account, and then it hires traders to trade it, and you trade it, trade the markets, and you get a split of the profits that you make. So in most cases, it used to be 50-50, and now it's a lot less. I think there are deals that are at 25%, which is really awful. But I heard about the opportunity on Thursday, and I packed up a car with this friend of mine, and we drove up to Chicago, and we're here Friday. That's how desperate I was to continue to trade instead of going back to a regular job. And then by Monday or Tuesday, we had a deal, and then I moved from Florida to Chicago to learn to trade futures. The pattern here is that I always traded around and with professionals, so I wasn't at all exposed to, trading from home or the issues related to that, and I became familiar with those issues around 04, 05 is when I started to see what the issue was with trying to be a trader on your own. It's doable, but it's not as easy, or it's a little more complex than doing it in a professional environment. Within 9 months or so, I became very profitable. I went through a substantial drawdown in my prop account. I became profitable and actually was net positive in about 9 months. And I noticed that there were some irregularities within the prop trading firm that hired me, and so I got myself fired. And when I did, by that point, I was already training new traders who were being hired by the firm for a split and so forth. So I had a little bit of a background in mentoring and so forth. So I split off and I started to trade on my own. I went to Advantage Futures at the time, and they had just opened their doors to private traders, and I was one of their first clients. And just to set up in a main trading area, and then started to bring people over, mostly friends who wanted to trade and so forth. And then eventually that turned into having my own room within Advantage Futures and becoming a full-blown prop shop. It just seemed like trading with others was a lot better for me, and I did a lot better doing that. And so I became a prop futures firm owner within Advantage Futures office. I later, I think in 08 or 09, I left Advantage and set up an office elsewhere in the Board of Trade, but that's basically the pattern. In 05, I noticed that my traders and myself had to trade a lot bigger to make the same amount of money. At this point, we still were momentum scalpers. I would scalp anywhere from 1,600 round turns a day to 3,200 round turns a day. That's our method of trading. And with machines taking over the high frequency domain, it just became harder and harder to extract profits from the market. So I started to look elsewhere to sustain my business. I started to get online and look at forums like Big Mike's, and others, and started to, I chose this name, FuturesTrader71, and it kind of stuck since then. I began to reach out to other traders online to see what they were doing. The trading world's very secretive. Most traders don't like to speak about their edge because they're under this, what I believe is an illusion, and it is an illusion, that if you talk to someone about what you do and how you do it, that somehow you're going to not be able to make money anymore. And that's unless you're trading an automated trading system this is simply not the truth, because your success, and we'll discuss this later, your success in trading is not about, here's the technical signal and take it. Your success and many people's failure in trading is attributed to their inability to modify their behavior and their inability to execute when they're supposed to execute. So, and that's covered in some of the webinars that I have on my website that I did for charity and to help people out, but we'll talk about that later as well. So I went out and started to look for an education. So I joined my first educational, I took a seminar. I flew down to Atlanta and took this this seminar, and I paid money for it to try to learn how to trade, market profiling as a professional. And it was obvious to me from the beginning that those people who claim to educate and know, hang on a second, I need to turn off Skype, just 1 minute. Sorry, just didn't want those things to pop up. I just learned that people claim to know so much, but they don't really, they teach because they don't know. And so I started to kind of feel the pain and be exposed to the pain of trying to find a resource for information to learn a profitable edge. So the next step after that, I joined a paid chat room. I paid for a chat room and I joined it and started to look in there. It was a market profile chat room, and it seemed more like a circus and a lounge than real trading. It was very inconsistent. I tried to improve the environment that I'm in wherever I go. I'm not trying to sound immodest, but that's really a value that I hold to. And so I started to contribute a lot. I started to call out live trades, and I was quickly made a moderator in that chat room, and things were going well. But I think a few of the people who had been there a while and had some influence just didn't get along with me really. I would call people out, and people don't appreciate it. I was just being arrogant. People don't need to be called out. And then I decided so I quit that, and I decided to create something better. So I went to Ensign Chat and created my own chat room for free, where you could only join through recommendations, recommendation by an existing member, and that went well for a while, but it was very draining and it was very distracting to my trading. So I next took a kind of disappeared for a while, and then a friend of mine said, hey, let's talk over Twitter. You should check this Twitter thing out. Let's talk over Twitter. And what I would do is get on Twitter, and this was in mid-09. I would get on Twitter and I would just tell them, hey, this is what I'm looking at, this is where I'm going to get short, this is what I'm stocking, this is what I expect, my hypothesis for today is this, this, and that. And we would chat back and forth, and then one day the market was so dead, I just used a cuss word, and he wrote back and he said, watch what you're saying, you have like 350 followers. And I didn't understand what Twitter was at the point, that people subscribe to your feed, by just following you. And so I realized that all these people had been following me. I'm making myself sound really old and ignorant, but I'm not. But I just didn't look into what Twitter was. So pretty soon people started to ask questions, lots of questions. I started to answer them, and you had only 140 characters to do that. And then what I would do is, because there were so many questions, I would go to these places like tinychat.com, where I would just open up a webinar and allow anyone to join, and we would just talk, and I would try to record the screen and shoot it out to people who wanted it. And then eventually I was invited to speak for Hamzai Analytics. He at the time had a pretty decent following. He had about 3,000 users. And I came on and I did this talk in November of 09 about overcoming the inconsistencies um, overcoming the obstacles to consistency. And I give you the link to it there, and Anthony will post that same link. I suggest you watch it. It's a basic run through of what I do, but it had a little more detail than I can cover today. And that set things off. And then folks started to suggest that I maybe create a blog and just answer these questions in a blog post so that I don't have to keep answering them and I can just refer to the blog. So I created a Google blog, a Blogger blog, and that wasn't enough. It became overwhelming. People found me. I think I've received over 6,000 emails from folks who need help, and I want to help everyone, but it just becomes very tedious and overwhelming. So what I decided to do is I'm either going to withdraw and go focus on trading and building a new prop group, which is what I really wanted to do, or do something different, start charging, or get a clerk, get somebody to run the thing so that it just I don't have to deal with the technicalities of posting a video and recording it and all that stuff. And then a follower suggested, well, hey, why don't you just create a webinar series and charge for it? And I thought, no, I don't want to be somebody who charges for stuff that that they need to be able to trade a little bit better. But I also started a charity in January of 2008, and we lost some funding for that charity, and I thought, and it was a tax-exempt 501c3 charity, and I thought, that's a win-win. I can create the webinars in a series of about 12, and I just took my training manual from my prop shop, and I started to take material out of there and go over it. And so I thought, okay, I can just have the charity create a PayPal, and then people donate to the charity, and then they would get these webinars, and that's really then things took off. I got more with doing that. Somehow I earned people's trust in that I wasn't taking their donation, and it just went to the charity, and then they would just get the videos, and I would just spend a lot of time just creating the videos, and I created 4 of them before I had to stop. This, of course, generated even more attention, more questions, more demands, more requirements, and it just interferes with your trading to try to keep up with that stuff. And at the same time, I'm still tweeting my fills, I'm still telling people what I'm going to do, and so on. So it occurred to me at a point last year, in the summer of last year, talking to a broker friend of mine and I, that, hey, these people really need help. Anybody who wanted brokerage, I would push them to Anthony, who now works with me at Vancar. And but still, I didn't know about people's issues. Like, I didn't know if people were following their plan, if they were doubling down on losses, and so forth. So I thought, if I became a broker and started a brokerage, I can create something that's similar to a prop shop. And so what I could do is continue doing what I love, which is trading, education. I just enjoy the process of watching someone, not the struggling part, but they have to go through the struggling part, but watching the light bulb go off and watch their life transform completely through their success. And so we started to pursue that venue, and so we thought, okay, we can create something that took some coaxing to get Anthony to finally come over, but I finally got him, and we started this brokerage in November of 2011. So with the brokerage, what I can do is then offer my education to a smaller and much more focused group, and and go into more detail. Because what was happening is, through the webinars and my chats and so forth, and you can go to my website, it's listed at the bottom, and you can go to resources and look at the chat archive to see how many chats we've done in the different subjects, and it's just a wide array. And then, you know, because of the questions generated, I started to make the chats member only for the website. To be a member, you just had to get one or all of the webinars. It didn't matter. Just to stem the flow of questions and requests. And so, you know, I thought, instead of speaking in general, those people who invested in us and brought their account over and used the tools that I would create for them, tools that I had created for myself using XTrader Pro or whatever. You know, I had people program things for me. Now have been adapted to the brokerage, and so they can come in and then I can focus on this group, because what was happening is those webinars that I put online would be, I would get somebody subscribing and watching them, and then the information was being plagiarized and it was being offered out at much higher prices by others. And so I figured I would invest in the clients that were investing in us. And last week we started our webinar series for clients, and to talk about specific things using the tools. And then that's where I'm pursuing the learning program. I'm still continuing with the online Twitter stuff and the website and so forth, because not everybody can be a client, but it just allowed me to focus a lot more. So it gave me a kind of a 2020 vision type of idea. In addition to that, so let's just follow the slide here. So education will be focused on clients. Being a broker, I can see what they're doing, help them manage risk, and to disrupt bad habits. And that's what I do all day long, as I sit there, trade, do other things, and then if one of our risk alerts go off, and we have a risk alert for each client, then we watch what they're doing. I pull up the trade analyzer, I look at their trades, I look at their statistics on their trades, and my job is to determine, are they trading out of their monkey, what I call their trading monkey, or are they trading and following a plan, but they happen to take a series of losing trades. And so that's what we're building. So what I had created is something incredibly unique, in that I'm creating a remote prop trading group, but in the form of a brokerage. So you're risking your own money, and it kind of separates. What it does is it separates those people who just ask you a lot of questions and frankly waste your time, in that they ask a billion questions and then try what I'm talking about for a week, and then they move on to the next guy, and then they go to another form, and then they go to another form, and essentially multiply that by 1,000 times, and it's just very draining. Just a side note, I can't see your questions yet because I'm on my laptop. I'm actually traveling. Anthony's going to try to take care of the questions as much as possible, but there will be a time at the end for me to address specific questions, so I don't want you to think I'm ignoring you. So we joined forces with a clearing firm to clear our trades, and we're using their trading platform labeled to us, and then we started to adapt some of the tools I used and created for my personal trading and for my traders for use with our trading platform for clients. We're building our own high-performance trading platform and execution system within Vancar. We're hoping that'll be released in about 2 to 3 months. It's built from scratch. It's built on Flex. It's for those who auto-execute their trades, as well as traders, just self-directed traders, but we also execute our auto trading systems on them, because that's what Vancar is known for, is creating high-quality auto trading systems that trade on people's accounts. Then we hold client-only webinars to cover a continuous process of education and support. I get to know my clients personally through their trading by just talking to them. I pick up the phone at least once a day to call someone and say, tell me your plan. What is your risk for this trade? Why are you trading here? Just to make sure that their emotions aren't taking over. And that's really what gets you as a trader who's inconsistent. It's your emotions. It's not your whether your fibs are correct or whether you're fibbing the right prices. It's really your emotions. And I spent a lot of time demonstrating that. And in fact, yesterday's webinar for clients was about entries and talking about how important or unimportant entries are versus trade and risk management. We continue to provide more exercises. So in webinar 3 on my website, it covers psychology, which I think is the heavy part of trading. My skill as a trader, and I've probably traded, I don't know, probably 1 million contracts in the last 10 years or so. My skill as a trader has nothing to do with my tools and my approach. It has a whole heck of a lot to do with my belief in the market and in my belief that probabilities dictate what trade I take. And so I'm trading from a probabilistic perspective rather than an emotional one. And there are days where I have lapses, and I have my own monkey where I get emotional, I didn't sleep well, I get irritable, and I end up getting myself in trouble before realizing that I am. And that as I grow and my experience grows, what happens is I become better and better at recognizing the monkey and stemming it, stopping it. And that's something that I know struggling traders have a hard time with. We now have the statistics, so through this brokerage model, we now have the statistics, trades, and details needed to help a trader. You know, like I think of Mike, for example, the person who runs this forum. Mike probably gets hundreds of emails of people trying to figure out if this is legit, that's legit, if their approach is right. And Mike is probably answering those as much as he can. And he's probably saying, yeah, you know, this works for me, and I think using that works for me. And this person will write back. And so Mike's going back and forth. You know, he's developing this, whether he likes it or not, he's developing a kind of a connection with this email he decided to answer. But what Mike doesn't know is this guy doing what I'm telling him? Because he's coming back and he may be saying, hey, I don't, this isn't working for me. You know, you said this, it's not working for me. But Mike cannot see what this guy did. When did he enter? When did he exit? Where was his stop? But as a broker, I can. And that's the difference. That makes a huge difference. It tells me who's serious, who's not, and who deserves a lot of attention, and who, unfortunately, should invest in an automated trading system or do something else. You know, and not everybody's cut out for this. But the idea that almost everyone fails, as vaguely repeated all the time, I think is untrue, because in my prop shop, almost everyone was successful and was able to finish out their term and their contract, and they continue to, some of them continue to trade. So I don't believe in this, what is it, 8 out of 10 fail or 9 out of 10 fail. I don't believe that, because maybe those 9 who failed are trading in boxer shorts in a closet in their grandma's basement using a 64K modem line, and they're plotting their charts by hand, and they're trying to trade you know, a high-speed product. So I don't really know. Hang on. Can you all see my screen? Anthony or Mike, just let me know if there's an issue. Okay.
There are the majority of people say they can. There are a few people that say they cannot.
Let me stop it, restart it. Okay, hopefully that solves it. If not, I think I use GoToWebinar as well. I think you might have to just jump out and come back in. So the other alternative, you know, in addition to brokerage, which is the key element of education, the other thing that I got involved with last year is creating automated trading systems. So we put together a group of traders who have experience, and we, who have an edge, and or a proven track record, and then we put these traders together, and we formed a group, an entity that where we come together, like, imagine Knights at the Round Table or whatever, and we look at every person's approach, and then everybody contributes an approach or a strategy. And then we hired a PhD computer science, computer engineering major, very, very brilliant guy. We gave him MATLAB. We gave him a really expensive Thomson Reuters tick bid-ask data, and he basically sits down in these meetings and takes the ideas, and then all of us contribute to the ideas, and then we've created these in-house automated trading, futures trading systems. We don't manage people's money, so these are not managed funds. These are what's called letter of direction systems, where you open a trading account through us, and you authorize us to put a system on your account. And we have performance reports, and they're held by a CTA, which is right. This isn't like those fly-by-night automated systems. This is a little bit more in depth in that we have a CTA that is, NFA regulated, audited, and so forth, that markets the systems, and we're just the executing. We create the systems, the traders create the systems, but our brokerage executes those trades. And we have outright systems, we have calendar spread systems, intercommodity spread systems, diversified programs, and so forth. So that's the other part that I got involved with, and it's just an alternative because some of you cannot trade and put in the hours needed. If you've ever read Malcolm Gladwell's Outliers, there's this idea that it takes 10,000 hours to become a quote-unquote expert on anything. And if you're keeping a day job and you're trading from 7 till 8, 7 to 9 in the morning before you have to run off to class or whatever, this provides a way to take your trading money or a portion of your account and put it in a system that trades it for you. Hopefully the system has an edge, and of course, past performance is not indicative of future results. I need to say that. And that's what that leg of the business was for, or of my vision was about. So let's talk about my approach. So that's my history and what I've done. Let's talk about my approach. I started out, it would be hard for me to talk about my approach without telling you what I failed at. And what I came into trading as is a high volume, high speed momentum scalper. And I had to take a step back and come out of that time frame, as I couldn't compete through these HFT or high frequency trading systems, scalping systems. So I started to look at geometry, fibs, stochastics, RSIs, MACDs, you name it, I've been there. CCI, Woody CCI, indicators, cycles. Heck, I even read a book about trading wheat using moon cycles. And what I used to do is create, instead of just clicking in my chart and putting up a stochastic, what I used to do is create a link to Excel and create the stochastic myself and make sure it matches what's in the chart. And that's an effort for me to understand what it's doing. If I want to trade off of it, it better be something I understand. It's kind of like a Navy SEAL who loses his weapon at a mission. He doesn't pick up the next rifle and just shoots it. He kind of looks at it, takes it apart or whatever if he has a chance, or checks the chamber and so forth before he starts using it, right? It's the same thing. I need to rely on this thing, so I want to make sure that it works for me. And so that's essentially what I did. And I found that it's pretty random. You could trade a moving average crossover back in 05, 06, and it could work for a while, then it could go dead. And I didn't understand why.
And the reason was I didn't understand what the market was really doing. So I felt there was something bigger. Something bigger's moving this market. So I looked at market profile, which is just, and I'll talk about this in the next slide, market profile is just a way to represent the same data that you see on your charts, no matter what kind of a chart you use. I explored market profile. I read Stadelmeyer's manual from the Board of Trade. It was free. It's like 400 pages of pure boredom. Then I read Mind Over Markets, and I started to create the profile on a piece of paper, even though I was using CQG, and I kind of grew up as a trader using CQG. And that's the software that Stadelmeyer initially created the market profile on. I still did it on paper, and I would figure out the value area on my own. I'd figure out the POC and study POC movements on my own, so I became very good at it, but it still didn't give me the answers I wanted. So there's something bigger. So I learned about the auction market theory. And what it says is all markets operate as an auction process, regardless of their sophistication, technology, or product. Doesn't matter. If it has a price and it trades, it's trading on an auction process. The purpose of the market is to create a price discovery process where the maximum number of buyers and sellers will agree on price. So the purpose of the market, think of a cattle auction. You're trying to find the price at which the maximum number of buyers and sellers can interact or transact with each other, right? That's what the market's trying to do. So given the current number of cattle available and the current need for cattle, there's a price. And what the market does is it rides high until nobody wants to buy anymore, and then the sellers start dropping their price. And then it rides too low until the sellers say, no, I can get more, and they don't want to sell. And then buyers start raising their price until you get to a point where a whole lot of trading happens. And that's what's generally called the point of control. Okay? Price is merely a common measurement of what the current value is of any given product. It is universal and has meaning to participants. Okay? The market will auction lower to invite more buyers to step in and participate. The market will auction higher to invite sellers to step in and participate. It auctions by advertising prices up or down, which are expressed as bids, offers, and actual trades. And that's what the market profile plots, with a caveat. The market seeks value by rotating higher or lower, depending on how much supply or demand is available for any given product. There are never, I'm going to repeat this. I hear this all the time, and for some reason it's a pet peeve. There are never more buyers than sellers, ever. Because for every buyer, there's a seller. There isn't a print that happens in the market where there isn't a guy buying and a guy or lady selling. Okay? So there are more aggressive buyers, so they reach out to higher prices. There are more aggressive sellers who reach down to lower prices. They hit the bid, the sellers hit the bid, or the buyers lift the offer. And that's what the delta is. That's what market delta is built on, right? How many people reached out to trade at a higher price as opposed to just waiting for their order that's sitting in the market to be hit or lifted. I just need to get a ping back. Have I lost anyone so far? You all with me still? All right, good. I may be talking too fast. Okay, so let me redo this slide. So realizing that market profile puts the market into 30 minutes slots called TPOs, I felt that I could get more information out of the auction by looking at volume. The market profile was created in like '83. And at that point, you had the Chicago Board of Trade's data bank report and so forth. And they worked in, there's a sound that goes off in the pit every 15 minutes. And what Stadelmeyer did was he looked at 2 of those cycles for each TPO, so 30 minutes. And so I felt that with the technology that we have, I can look at actual volume, because to me, time doesn't matter. I love it when somebody says, "Oh, you have to wait for the 5 minute to close above the moving average to change the mood of the market. But what if it closed on the 2-minute? Why is that any worse? What about waiting for the 15-minute or the half hour, or the 60-minute? So that didn't make sense to me either. And this is a personal preference. I'm not trying to put anybody else's method down. Ultimately, it's not your method that makes money for you. It's your mind, it's your psychology. So I started to want to eliminate time as a factor. So with this TPO thing, I learned that where market participants accept price, they continue to trade, and an HVN is formed, a high volume node or a high volume price. Where market participants disagree on price, they quickly reject it, and an LVN is formed, a low volume node. Where market participants accept and trade price so much that it creates a price that stands out more than all others, then that is a volume point of control, or a point of control. And I'll show you a chart and explain those terms, and that's also available on these terms, all these acronyms are available on my website in the glossary. Traditional market profile consists of TPOs in the form of letters that represent 30-minute increments of time, but offset to the left and in the shape of a histogram. And I'll show you, this is what a profile looks like. This is a balanced profile. This is a vertical profile. This is where the market's seeking, can't find a good price, so it just goes up and moves through prices quickly. That's a trending profile. This is a balanced profile, trending, balanced. This is a long liquidation profile because a lot of the volume happened at the lower end, stuff like that. So these are each one of those colors, the little dots, and they're actually letters. As when price crosses when the market trades at a certain price, it creates a time slot for that, and that's what a market profile is. Okay. It's not a trading system or methodology. Market profile is simply a way of organizing data. Oh, we have reached our maximum, I guess, in the room. Advantages: it makes it easy to see where the market has spent the most time. Disadvantages: does not give you any perception of how much traded anywhere. Yeah, okay, price crossed 1300. Boy, I'm getting a lot of alerts. Price crossed 1300, okay? But how much traded there? Like, with what kind of interest? Yeah, I see the price crossed 1300, but what does that mean? And market profile doesn't show you that. The disadvantages: doesn't give you any perception of how much traded anywhere. There are also many misconceptions about what it is telling the trader. I do not believe in value areas in the traditional sense. Market profile talks a lot about, taking 70% of the profile, centered around the point of control, and that's your value area and so forth. And I believe that that's a myth. It sounds great in statistics on a Gaussian curve, and I can go on and on about it, but it doesn't really apply in real life. Much of the theory and application of market profile revolves around the time brackets. After reviewing this for years, I see a better approach. So again, this is a market profile chart, prices on the vertical scale, each one of these profiles. So this profile here represents yesterday. You can see we gapped up on non-farm payrolls, and it was a short covering day because a lot of the volume happened at the upper end of the day. Okay, and then the brown lines you see there are point of control. That's our point of control. That is the point where the most number of half-hour brackets cross the price. So this is the longest series of TPOs, so to speak, time price opportunities, and it puts this brown line up to tell you, hey, this is the most accepted price. In this case, it looks like 39.5 or so. 1339.5. And then with this particular charting package, I use Investor RT by linsoft.com. In this particular situation, I have it extend those points of control forever. And there's a good reason for that, because the market, wherever you have a point of control, that is acceptance. Remember, the market moves up high enough to stop buyers from paying up because they don't see the point. And it moves low enough to stop sellers from wanting to sell because it's too cheap. And the market trades a lot where buyers and sellers agree on price. So that's why we call it acceptance. That's the most accepted price. It's important to know what acceptance is. So what we're doing here with market profile is we're looking inside the bar. And then with my approach, I'm looking even more inside the bar. So a 5-minute bar tells you it traded an open, high, low, close, right? And it tells you it opened at 1300, it went to 1305, and it closed at 1304, and it opened and the low at the same price. But you don't know along that 5-point range what was accepted and what was not. And that's what volume profiling is for. The volume profile approach. It simply displays volume at price data for any given time frame or duration. It organizes the volume, doesn't care about time. So a 5-minute volume profile, 60-minute, 120-minute, 3-minute, 15-minute, it gives you the same information. So the element of time does not matter anymore. And that's how I like it. I just want to see what was accepted and what was not. It organizes the volume information the same way as market profile does, but is not restricted by time. Time's already represented in the bars overlaid by on the volume profile. So I'll show a chart where you can see the bars and see the volume profile. So if I want to see the bars themselves, I have that. But the more important information is what actually traded within that bar. Advantages: does not change the outcome of the profile even if the time frame is changed. The data is the same for all participants. So you and I, if you're looking at a 15-minute volume profile chart and I'm looking at a 5-minute, we're both looking at the same data. It doesn't change what happened or how much traded at each price. Okay, that's a big edge. The disadvantage: it requires a very high quality data feed from a reliable source. So I use DTN IQ feed to get my tick data, and I need it to be high quality data. I used to use CQG, and their data is probably the best out there, just like DTN's is, but I couldn't customize it. Your volume profile is not as useful if the volume is simply distributed over 1-minute bars. So if you look at TradeStation, they don't give you the actual volume on a tick data basis. They aggregate it. So does Thinkorswim, and so do many outlets, and they do it for a good reason. They do it because it reduces their bandwidth requirements. Okay, if you sent out tick data, you're going to be your servers are going to be blasting a lot of information out. So creating a volume profile on TradeStation or Thinkorswim or some of these other outlets doesn't give you the quality of data that I would personally feel I can put on size in the S&P, and I trade a fairly large size in the S&P. I can't confidently trade that, okay, without knowing that my information is as perfect as I can get it to be. So here's what a volume profile chart looks like. The faint blue profiles, and I'll pull up my charting system here in a second and in just a little bit and show you and go over yesterday's trading in the last week and talk about what we've done and what we're likely to do. So you can see this is a 30-minute bar chart. Okay, each volume profile represents 1 day of trading, and that's tick volume there. So you can see that outline, the blue outline, and then the pink line that's sticking out of it, that is the most traded price for that particular day. So you can see Wednesday. Excuse me, Wednesday and Thursday had the exact same volume point of control. Wednesday and Thursday, basically the market said there's no information to add, there's nothing that wants me to change to see value lower or higher, so we're just going to trade within the same profile, and in fact we're going to trade the exact same accepted price from the day before. So you can see that it just traded 22.75, 1322.75, 22.50 both days on top of each other. When this happens, the market is waiting for information, which we know what that information is. It's the non-farm payrolls or the unemployment report that came out yesterday. It's priced in everything it knows about the S&P 500 right now. And that's what it's saying. And that This type of setup portends a big move out. Markets move from balance to imbalance to balance to imbalance to balance to imbalance, and that's what they do. They go from balance to imbalance, and that's what they do. Why? Because the market's job is to price in value. You know, if you found out if a peanut butter jar costs $3 in your local grocery store, or a loaf of bread, let's use a loaf of bread, that's universal. If a loaf of bread costs $2 in your store, so you go to your local store and you buy yourself a baguette for $2, but then there's an announcement that war is coming. And what's going to happen? The price of that bread is going to shoot up to $8, right? So the accepted value was $2, and everybody was happy selling bread for $2, and everybody's happy buying bread for $2. So you have a volume point of control of $2. War breaks out. It's World War II. War breaks out. France is getting invaded. The price of bread shoots up because the buyers are now willing to price in the premium of war because there's going to be scarcity of bread. So now they're paying $5, $6, $7, $8, $9, $10, and it shoots up. And that's what's called vertical development, and they're pricing in the new value. And when it gets so expensive that, you know what, I'm not going to pay more than $10. All right, I'll sell you for 10. Okay, 10 bid, 10 bid, 10 sell, 10 sold, 10 sold, 10 bid. And now you create a new volume point of control at $10. I hope you all understand that. The October 11th, 2007, shown on the chart here, that identifies this black line is what's called the composite profile. And what this is doing is it's forming a profile of all the prices and all the volume that traded back to this date. Okay, I suggest it's a modest fee, it's a donation. If you need more detail, I suggest you just get the webinars, especially for this particular question. You get webinar 2. And it's basically displaying everything that happened since this date. Why this date? Because that was the high, that was the highest high in the area. So I go and pick the highest high, the nearest highest high, so I can see what has happened since, and that's the high of, I think, 1545 on the adjusted or equalized S&P contract, continuous. What is my approach? I make sure that I have complete tick data for the time frame that I'm using. I break down the information into overnight trading. So I look at the overnight, I look at the regular trading hour chart, I look at the composite to see what the big targets or what the big trend is. Are we moving towards a composite volume point of control? Like this line here, 1310 quarter. I know the numbers are hard to read. See this brown line? That is the most traded price since 10/11/2007. That's what this is telling us. And this was a beautiful trade. You know, we came up to it and failed. It's off the chart. We broke through it, came back to it, and came off. Then we accepted it again. Then we broke below it and went to it, 1310, and stopped. Then we broke above it, broke through it, and stopped right at it here. Then we broke away from it, and now we're ready to start moving away as more new and good information comes in about the economy. So this brown line is the volume, the composite, which is this black profile, which is an accumulation of all of these individual profiles put together. This black line here is the composite volume point of control. And it's a key metric. If we get above it and we start to move through these lower volume areas, then the market will keep moving forward. Is likely, nothing is definite, is likely to keep moving forward. And so my main target above here is 1315. It's not because, hey, I can look at a chart and the high is 1350, so that's where we're going. No, it's a little bit more involved than that, and we'll look at that in a minute. So that's what the composite is. My hypothesis is based on a top-down approach for all three. So I'm creating 3 hypotheses. As soon as the market closes, I'm adding 2 more in the morning when I see the overnight, what the overnight action is. So I look for three, starting with the composite, which I display usually daily bars, but which will contain tick volume. So my composites are made up of 405-minute charts of bars, and I look at the regular trading hour only. Once I discover the bigger areas for the market to do business, I drill down to the regular trading hour sessions, so the individual bars. So I look at a 3-minute net. I start with 15, go down to 3, and when the market opens, I go to a 2500 volume bar so I can see what the opening swing is. And look for detail that is reflected in the composites, but also take into account prior close, current open, highs, and lows. I integrate into the RTH session the information provided by the overnight session, so my charting package automatically gives me, you can see it on the right, it gives me the overnight high, the overnight volume point of control, and the overnight low. Okay, it gives me that every day. It gives me those. So I integrate that into the RTH chart. This is an RTH chart. RTH means it's when the stock market's open. So in Chicago time, RTH is from 8:30 a.m. till 3:15 p.m. Okay, we include the last 15 minutes for over-the-counter and all that other stuff to be integrated into the price for settlement. What is my approach? Once I have all of these pieces, I use these data points for major decision making and then watch for the market action as these areas are approached. Does that mean that my homework has to happen? No, I have 3 scenarios, 3 major scenarios that could happen, and I have 2 additional ones potentially, depending on what we do overnight. And all I'm doing is I'm waiting for the market to tell me which one will it pick. I've covered all the bases. Again, let's put this in a military analogy. There's a lot of combat that goes on in trading. They're very similar, except your life's not in danger, of course, which is not very similar. But you have a plan of attack. You know, everybody gets around the table and they look at a map and they figure out how they're going to get Osama bin Laden or whomever, and then they have a plan of attack. They have a lot of information, and they know exactly where they're going to do business, where they're going to land, which doorway are they going to break out of, but they're ready for multiple scenarios. They're ready for hostages, they're ready for whatever, and that's all you're doing as a trader, is coming in and saying, okay, I'm prepared to deal with 3 to 5 scenarios. Tell me, with the market opening, tell me which one you want to play today. I cannot impose on you, Mr. Market. I cannot impose on you which scenario you should trade. You tell me which one you want to trade, and I will try to find a spot to participate and ride with you that wave, that zone. Okay. Once the RTH trading is on its way, the current intraday volume profile becomes a dominant factor. So I have all these, volume profiles that I've studied, but I'm paying a heck of a lot more attention to the current volume profile that's being created and reading what quality auction am I getting. Imagine people in the pit. Is there a lot of screaming? Is it quiet? That's why people listen to Pit Squawk, although I used to listen to it a lot. I don't find it helpful anymore. But you want to see, is there strong action on the open, or is it kind of sideways, nothing going on, and then suddenly, a bigger trader or fund or somebody steps in because they have information that I don't have. I do not pay attention to value areas except under specific circumstances. I only pay attention to value areas on Gaussian profiles, or profiles that look fat like this, that look balanced. So value has no meaning unless there's balance. But most people who teach market profile just will not take that into account. If you have a profile that's long and thin like this, is there value? Is there really value? Can you call that value? There's no way that that's value, because they're not agreeing on price, and that's why it keeps moving up and down. Sorry, my laptop just got rebuilt. So there is no value. That's what this market's telling you. There's no value. We can't agree on price. We keep going higher and higher and higher, or lower and lower and lower. So the only time value really matters is when you have balance. Okay. Then I give it some weight, not too much weight, but some weight. Okay. So let's look at the composite. This is the most recent composite and it includes Friday, which is a nice lonely bar up here. On the right, you see the composite profile. The red, the more they move to red, the higher that, the more volumes being traded there. So the reddest number here is 1310, like I talked about, 1310.50, and the darker the color, the less volume there is, and that's what where that 1350 comes from. 1350 quarter was a prior high. Looks like 1351.25 was a lower high, and so on. These are the dashed green lines are highs and lows that are being carried forward and remain unbroken. So this is an important price, 1350, because it was since 10/11/07, this price has been rejected very swiftly. So it's an untested, it's a yet untested area. We're moving from a price that is accepted to a price that is not accepted. And the market likes to auction unknown prices to see if there's anybody there. You know, does anybody want to buy that loaf of bread for 11 bucks? No, no. Rejected. Market moves back to 10 bucks. The war's over. Boom. Prices fall right back to $2 on that baguette once World War II ended, right? In that analogy. Let's look at where we are in the market. What is the ES saying right now? What was my plan coming in? What it did, what it might do going forward. For the glossary, I think Anthony's probably posting this link. Just I'm going to speak a lot using acronyms, and you're going to lose me, but maybe you can look at the glossary and come back when you see the video if you're that interested to figure out what's going on here. So let's, I'm going to pause this for a second, and let's look at this. These are my charts. So let's look at the composite going way back. So this is what we've done. We've made the low during the crash of 608.75. We've slowly climbed out, balance, climb, and then here we have balance, climb, then we have major balance. All of last year, believe it or not, was a balancing period. So let's look at last year. So this is late 2010, all through last year. We have essentially this push up to 21, dropped 1321, dropped to 1226, push up to 50 quarter where we're headed, drop to 40.75, push up to 41. Then you have the Greece news, which dropped us way down here, and then it continues to balance for a few months as we don't know what's going to happen with Greece, so we go sideways. A little bit of good news, we break out, the economy's starting to pick up, then we go into balance, and then finally we start to create this trend up. We were in balance from the 19th until the 2nd, and wherever there's balance, I draw a micro composite. That's these. It's a profile that I'm drawing around specific bars in balance to see where the most important price is, because that's an area that's likely to be tested and retested. And I do that over and over wherever there's balance. And balance I'm defining with the market falling back on itself. When the market starts to fall back on itself, I start building the composite. These are 405-minute profiles, which is a day, but I have to use 405 minutes in order to leave out the overnight session. Okay, so these are 400, so each bar here represents a day, and every day that we are in balance, I extend this composite. So we started out with these 3 days, then I extended it to this day, on and on and on, all the way to the point where we jumped out of balance by breaking out over here. I'll change the color of this one. So, okay, and then on the 19th we started to rally, and then on the 19th we went into balance again. Why did we go into balance? Because we're trading against the most important price of the composite since 10/11/07. The other most important price is 11.52 down here, okay, and that shifted up to 1196, which is right there. Then it shifted to 1310 as we move up. So we're accepting, what this is telling me is we're accepting higher and higher and higher prices. They're just simply being accepted that way. Why am I using 1011 2007? If I pull this chart all the way back, you'll see that the first bar I'm using on this chart is the highest, is the swing high. So if I switch this chart to, let's say, 05, all right, you can see that the highest high is right here, 1545. And in my profile, I don't need to profile everything that happened before that point, because I'm only interested in how did the auction behave on this whole leg down, right? And since then. So I choose that. The day of the high, the 1545 high occurred on 10/11/07. That's what that date is. And so I eliminate everything that happened before that. So I move this chart to 07, and then a new profile is created that only has that into account. So this information, this profile here, represents everything up to 10/11/07. I'm only looking at the last swing down because we're trading it on the way up. I want to see what happened with prices on the way down. Again, I can't cover that in more detail here. That's what webinar 2 is about. I can talk about it some other time maybe. So where are we? The bigger trend is upwards, okay, towards 1350. That's the major force. That's the tide that's pushing all the boats towards the shore, right? But at the same time, we have gone through many, many prices without fully auctioning or fully testing them. So when I zoom in here, we still haven't tested the high price of this balance area at 29.75. We still haven't tested the point of control of the last day before the breakout. So that point would be 22.75. Okay, we've left a lot of areas. Now, when the market gaps up, it most often, unless there's bad news following it, most often doesn't just turn around and gap down. Most often it balances, tries higher. If it fails, it rebalances, and then it tests lower because it's saying, look, everybody's exhausted. Everybody sees this as too expensive. I can't keep pushing higher. I need to advertise lower prices to get those who missed the move up to buy in, because that's who has to fuel it. And those people who are perma-bears and really believe the world's coming to an end to be convinced to sell some more, because we need that fuel to keep going up. That's in an uptrending market, the opposite in a bear market and the downtrending market. So that's what we're looking at in the big picture, and the targets will be 1350 and 1351.75, which is the major LVN down here. Let me turn on my peak valleys. So the major price down here, the least traded price up here is 1350 something. The color's really horrible. Let's make it red. 1352.50. That's the CLVN, or the least accepted price in the area. Ultimately, there's just a very high probability that we end up testing that price at some point soon. Let's switch back to the intraday. This looks very confusing. I know, lots of lines, but we have built so much history in these prices that I have to keep putting these bands up to figure out where I'm going to trade, where my homework is. In fact, I'm missing the gap close up here. So this is a half-hour chart representing. So for each profile here, I think it's best if I change the color of these profiles to something you can see better. Let's see, red. Yeah. So you can see each one of these profiles represents 1 day. Each one of these profiles represents 1 bar from the composite over here. Okay, and so the best way to do this is to tell yourself a story. Is just scroll back and tell yourself a story. We have balance. Okay, so I would draw a micro composite against this to see within this balance area what the most important prices are. Then you have a breakout. Then you have balance. Then you have a break higher. Then you have balance. Then you have a big break higher, rejected. But look at the high. It reached an existing naked volume point of control. So this was an accepted price from way back, 29.50, 1329.50. Hang on, let's see what day that was. And that's why the volume point of control is so important. It's previously accepted price. The market moves from acceptance to acceptance. So that price, the 29.50, came from 7/22, July 22nd of last year. We tagged it and then rejected, sold right off, balance, and then a break lower. There was some news here, I forget what it was. This was on the 30th. I forget what that news was. Something with Germany imposing a controller on Greece and that being rejected, and it was putting the aid package at risk. So we gapped down and came back into balance by the close, gapped higher, and then rebalanced earlier this week on Tuesday, and then we gapped higher again and then just sat sideways in anticipation of our non-farm payrolls. I can do the same chart for the overnight only. So this is the overnight session. Is this difficult to see? I don't know. So you could see here's non-farm payrolls. This is the unemployment number. We sat sideways most of the session, and then the number comes out, and then we sat sideways and we opened up here. I can also do a 24-hour session where I can show, okay, the night session gapped up, and then the day session opened, it trended upwards and sat in balance for most of the day. So all of this is short covering. Where are we going from here? I'm expecting on Monday, Monday after non-farm, generally you don't get too much, but the market has an upward skew. So everything I'm going to do going forward is going to take into account the fact that we're in an upwards skew. So I'm going to be a lot more aggressive with the longs if I can catch them on a pullback than I am with a short. I'm probably not going to put a 2-unit short on anytime soon. I'm going to look from the long side, okay? So Monday I'm expecting balance to, we'll probably take out the 42 if we don't do it tomorrow afternoon or in the overnight session, 1342, and try to push higher, but I believe that we're probably going to keep turning back to the 39, 38 area and building up a little bit of balance here before the next piece of news takes us up to 47, which is a small rejected area here, but the ultimate goal is 51, 51.75, 51.25. There's a gap up here too, it looks like. So there's a gap open. That's what this dashed orange line is. It's telling me that there's a gap up there from some time in the past. So that's the look currently. I mean, I wish I could provide more. It's easier to read balanced than imbalance because anything can happen in a vertical market. But this has come a long way. I mean, this market has rallied a fair amount, and I expect, we've covered from 1296 all the way up to 1342 in a matter of about a week. The market needs to rest and attract better and advertise lower prices before it can move up in most cases, unless the government or multiple governments intervene. So back to this. What is the ES saying? Hang on. Let's shift gears a little bit. The struggle for perfection, the typical struggling trader. I'm just going to cover really quick the things that are working against you if you're inconsistent. The first thing is your personality type. I covered this in webinar 3. You have, every person has a risk profile. You're either a risk seeker or you're risk averse. Risk seekers tend to be a lot more aggressive. They tend to throw caution to the wind. And risk seekers are, if most of my traders are risk seekers, I want risk seekers. And then my job is to control their risk. So it's kind of like having an aggressive dog with a muzzle on him, So risk seekers are people who really have to have a good risk plan. You need to define, what are you going to lose per day? How much are you going to bet? What percent of your account you're going to bet on any given stop? What do you do if you're halfway to your daily loss limit? Are you going to change how you trade? Are you going to slow down? Are you going to wait for the later session? What? The next big thing that's working against you is funding and undercapitalization. If you're trading a $2,500 account, God help you. Essentially what you're doing is you're rolling the dice on every trade, because there's just not enough room. Trading a leveraged product, there's not enough room for you to make mistakes. Every contract of the S&P 500 is worth about $65,000, and you're trading it at a $500 margin. And that's one thing we just will not allow in our brokerages. Although we can provide, we can provide less than $500 margins. In fact, those clients who have joined us, who are really trying to help themselves, don't get $500 margins. It's just insane to trade that. So on a $2,500 account, you're not going to be able to make a career. I think, well, never say never, but 99.99999% cannot make a career out of it, because you're talking about some ridiculous returns to sustain just a normal lifestyle. So it's just not. You need to be well capitalized. It's hard to start a major corporation with $2,500, and you're investing in you as a trader. You are the corporation. Poor tools and execution. So what many people do is they try to skimp on the information they have. Like they try to skimp on the type of trading platform they have. So what? So it locks up, twice a day. So what if my charts don't have the right data? So what? I can still somewhat see the market. And to me, that would be great if you are trading in an environment or an exchange especially created for those people trading $2,500 accounts with tools that work half the time. That's great. You have a fighting chance against those people. But there is no such thing. You're in the big leagues. When you get in there, you're trading against folks who spend $20, $30 million a year on new software and new equipment to get the leading edge. You're fighting against banks and so forth. So you want to get as good a set of tools as you can find. The best example I have is, your goal is to compete in the Masters. You want to go up against, the great man formerly known as Tiger Woods, and you're trying to beat him, except he's showing up in, $10,000 golf clubs, perfectly balanced golf club, and heck, his golf club is so balanced it could probably stand on its own. And you're showing up with your Costco Dunlops that actually were driven over by your girlfriend or wife, and they're slightly bent, but what the heck, you're just going to show up and you're going to try to drive a ball 300 yards and out-putt and outplay Tiger Woods or someone else who's in the Masters. That's what traders do day in, day out. You need good tools. You cannot compete. You can't win a marathon if you don't have good shoes when everybody else does. So you need good tools. It's worth it. If you're a baker, you're not going to go to Toys R Us and buy one of those toy ovens, you're going to go out and get the best oven you can afford, and that's what you have to do. Shortcuts people try and fail with. So everybody thinks that if I pay this guy or if I pay that guy, I'm going to be able to get a shortcut into learning how to make millions of dollars in trading. And there are hundreds of thousands of people out there who are trying to sell you on that idea. And there is no shortcut here. This is a business. This is a business, and it's a high-performance business. What you are as a trader, and I've said this a billion times, what you are as a trader is a high-performance athlete. It's what you are. You have to have the same sharpness of mind, the same discipline, the same competitive outlook on what you do. You can't can you say half-butt? You can't half-ass your work here when you're trading, because then you're always trading out of fear and you're always holding on to losses and cutting off the winners as soon as you see a tick or two. And so people look for shortcuts. If I buy this indicator, if I buy this particular platform, if I pay this guy, if I pay for this course, it just doesn't work. Okay, so there is no shortcut. Try to understand the market for what it is, and I try to provide the foundation for that. And I'm sure I've put a few educators out of business offering this information for close to nothing as a donation, but I believe that people need some sort of need to rely on more than their job for financial security. I love trading. It's a passion of mine. It's the greatest job in the world. It's the most difficult job in the world. So I'm trying to help as many people as I can to really push through this and not necessarily make $500,000, $1 million, $2 million a year doing it, but if you can trade a small account and boost your income by $30,000, $40,000 and control your risk, then yeah, I want to help you do that. Naturally, there's a risk of loss, so you have to manage risk first and foremost. I always tweet out, risk is your #1 job. If you take care of risk, everything else takes care of itself. And I demonstrated that yesterday to our clients in a webinar about coin tosses and managing risk and sizing positions and so forth, or varying targets. Continuous switching of focus and approach, the random walker, right? You try this for a month, then you try that for a month, then you get this indicator because your buddy's making money on it, so it's got to be the indicator. So you try that for a month, then for 2 weeks you follow this guy who's making live calls. You don't know if he's trading or not, making live calls, and he's using this indicator, and I'm going to get that for $50 to put on my Ninja so I can trade it. It's people don't stick around or stick long enough with one method to ultimately have it work for you. In fact, if you get a dartboard, and I'm not suggesting this as a trading plan, but if you get a dartboard and throw darts and trade based on that board, over time you will have a better edge than these people. Okay? So it's just people don't last long enough to be able to really realize the fruit of their effort. Behavior modification. It's your main nemesis is you. Okay, behavior modification is all that trading is about. You want to read something useful about trading, read about behavior modification, read about psychology. The thing that everyone wants to avoid by buying stuff is behavior modification. So every once in a while, I put out an announcement like an impromptu, I call them impromptu chats, where I receive an email of a guy who's just lost his entire account and he's distraught and he's upset and he might hurt himself. And so I say, how do you feel about going online and talking about it, but I need to invite everyone else because somebody out there has your same problem. And I do these things called the trader analysis or a trader intervention. Trader interventions are more of me trying to help a guy through email and he's just not doing what he's supposed to do, so we have a trader intervention. Trader analysis is more of a guy has a unique situation and unique issue that I think others can benefit from hearing, and we do an analysis on what their approach is and their outlook. Okay, so there's a link for one, and I think Anthony might post it in the questions area. Thanks a lot, Anthony, for helping out. Then you have the let's look at what you need to do. The quote is always, the guy who's struggling always says, "I'm giving it my everything. I'm giving this my everything." And you ask them a few questions and you file huge holes in what their approach is as far as giving it my everything. You need to have a clean, isolated environment without distractions. Again, you're like a fighter pilot as a trader. You're like a high-end, high-performance athlete. You need your focus. You cannot be next to the kitchen where the kids are playing. You can't be the guy opening the door for FedEx. You can't be the guy helping, getting up in the middle of the day to help the cleaning lady, move your fridge or whatever. You need focused, isolated time. You need to be immersed in trading. You need to live off the market. Like, it needs to be your food. That's where you need to go. Okay, that's why it's faster for a person to overcome their obstacles in a professional trading environment than alone. And that's why we're trying to create that professional trading environment remotely through our brokerage. Not that I'm trying to plug our brokerage, but I'm very proud of what we're doing. Get your finances straight. Don't trade scared money. Don't trade money that you cannot stand to lose. If you can't stand to lose, don't trade, because losing is a part of trading. The example I used recently is, you need oxygen to live, right? Everybody needs oxygen to live. You inhale to get oxygen. You exhale and lose oxygen with carbon. It comes out as carbon dioxide. Okay? And then you inhale again to get oxygen. As a trader who doesn't want to lose, what you're saying is you want to survive by inhaling only. You just want to inhale. You want to bring in the oxygen. You want to make money, bring it in. You can't lose it. But the fact is, to survive, you have to exhale, and the exhale is the loss. There is a loss to trading, and it's inherent. If you try to avoid losing, you attract more losing, because you're going to act, your monkey's going to come out, and you're going to act like outside of your homework and all the work you did. You took time away from your leisure and your family to do all this homework, and then the market opens, and then you start to trade like a complete monkey. Okay, it's because you're afraid to lose, and that's the major behavior modification. In webinar 3, I talk about how losing is a natural part of the process, and the fact that losing is a 50-50 proposition. You're gonna draw a loss every day. Okay, use good tools. Don't show up to a gunfight with a bent butter knife. Right? That's the example of the golf club. That's what people do. They show up to a gunfight with a bent butter knife. It's not going to cut it. You might get away with it here and there, but it's not going to cut it. Get good tools. Don't skimp there. Figure out a realistic time horizon and set your mind to give it your all. So set a deadline for yourself. Tell yourself, by this certain time, I need to have attained this level of skill. Not how much money. Notice I never talk about money whenever I talk. I never talk about money during these webinars or in any of my materials. We're not trading for money. The money is a result of trading, but almost everyone enters trading for the money, and those same people have to suffer a whole lot to learn that it can't be about the money. I'm trying to save you by telling you that it's not about the money. So pick a time horizon and attain a level of skill within that time frame, period. Your mind's your holy grail. Focus on psychology and document what you're doing. Without documenting what you're doing, you're probably trading randomly and you're getting random results. And you're looking at yourself and you're going, why the heck am I not making it? Do your own homework. Believe in yourself. Pick your spots. Do your own homework. The moment of truth comes in when your order gets filled. When your order gets filled and you didn't do your homework, that's when you start to go, gee, did Jeff give me the right level? Did he take into account this? Did he say that this would happen? Why am I taking this trade again? That's what happens when you don't do your homework, when you start believing and listening to others. Beliefs and expectations. Check your core values. What is important to you? Is hard work important to you? Is greed something that you have within your core being? It's not going to work too well in this business. It'll take you time to shed that. It'll take you money to shed that. Most of all, as a trader who's struggling, you need to commit to let the market speak to you. Listen to the market. Don't tell it what you want it to do. Don't tell it that you're going to rally and you keep going long every opportunity you have on a downtrending day. Listen to it. Look at where it opened. Look at what it did. How did it auction after it opened? Who took over? How are they doing it? You know, how good of a job are they moving? Where are they moving to? Where are they moving from? Just listen to it, okay? It's telling you a story. All you have to do is line yourself up. The market, the best analogy for trading is probably surfing. You know, it's great that, you know, your method of surfing requires a huge wave. But if there are no waves that morning or that day, you could go there and flap your arms around all you want, but you're not going to get a wave. As a trader, your job, just like a surfer, is to read that hump that's way out in the distance that's rolling towards you. Read it, and it takes time to gain that skill. Read it as it comes towards you, and then practice getting on your board and get in line with that wave so that it carries you with it. And if you don't execute it right, bail. Because if you don't execute it right and you're a surfer and you let things get out of hand, you're going to find yourself slammed against a bunch of rocks with a whole bunch of broken bones. So, you know, you're trying to line yourself up with the next wave and just ride it. And it takes skill, it takes time, and that takes money. And so you need to be well funded, like I said in the prior slide. I think I'm getting long-winded here. The principles of trading success: treat trading as a business. Trading is about accepting a probability and knowing that the very next trade has a 50-50 chance. I don't care what you do and how much homework you do. The next trade is either going to win or it's going to lose. And I'm considering a scratch a loss because you lose your commission and you've risked something for nothing, and that's a loss. Okay. The next outcome, even if you have a plan that says you're 90% likely to have something, the next trade could be in the 90% data set of winners, or it could be in the 10%. You have no idea, because you could have 10 losses and then 90 wins, or you could have 90 wins and 10 losses, or you could have 100 wins for that particular time frame. You just don't know. So all you can do is stack the probabilities in your favor and trade them. What does that mean? Because you have a 50-50 chance, you have to be ready to take the loss, just like you're ready to keep the winner, right? Keep track of your victories and defeats. Nothing will provide you with more feedback and protect you from self-deception than a good journal. Make it simple, okay? Just print out a chart, for God's sake, and write down where you traded and why, okay? Start there. Something, anything, because you'll start to learn something about yourself. Do not trade for dollars. On my platform, there is nothing that tells me what my dollar value is. Nothing. Because I don't trade the dollars. I don't make money through the P&L on my account. I make money by aligning myself with the market and executing my trade and giving myself an A grade for entry, A grade for management, and A grade for exit. That's my job. It's not just because I'm down doesn't mean I should trade twice the size. Just because I'm down doesn't mean I should hold on to this trade much longer. Doesn't make a difference. The market doesn't care what your P&L is. The market cares about prices, buyers, and sellers. That's it. Period. Your P&L shouldn't even be on display anywhere, because the P&L is the steroid for your monkey. It feeds off of it, loves it. That's when it comes out. You know, oh my God, okay, I got two ticks. Let me close this trade. Oh man, I'm in a 2-point loser. All right, it'll come back. God, please come back. You know, you hold on to the loser, you take the 2-tick winner. When your job is to just, with a 50-50 probability, is to make a decision, make a hypothesis. I think the market is more likely to do one thing over another, enter that thing, and just let the market take you out. Don't take yourself out. You know, you don't come into practice for a boxing match, get in the ring, put up your gloves, bounce around a little bit, and as soon as the guy takes a swing at you, you say, oh, to hell with this, and you punch yourself in the face, you knock yourself out just so he can get a win. You don't do that. So why do you do that in the market? People do that all the time. It makes no sense. Don't take yourself out. Create a hypothesis. You're a lab technician. You think that this next experimental trade is going to do one thing based on your beliefs, your probabilities, okay? And it doesn't have to be an exact probability. It's just all you need as a trader is something more likely happening over another. That's it. So you're, as a technician, you're saying, I think given A, B, C, and maybe even D, that we're likely to rally over sell-off. So I'm going to try to find a spot where I can take some risk and pay the amount of my stop to find out if my hypothesis is correct. That's what your stop is. Your stop is your cost to see what the next card is. That's all it is. It's like in poker, you know, you have to put in the minimum to be a part of this particular deal, right? And to see what the next card is going to be. And most people ante up and then they fold. Ante up and they fold immediately. It's idiotic. Sorry, but it is. So as a lab technician, you're looking for something to happen, and you let the market tell you what it wants. You're basically saying, Mr. Market, I think you're going to go up. What are you going to do? Here, I'm going to pay you. I'm going to risk this money. I'm going to put this money right here on the shelf. You can take it if I'm wrong, and if you're right, I get to keep it plus more. And then you let it do its thing, okay? But don't try to do your homework and plan and figure out what you're going to do when the market's open and you're about to put on a trade. It's too late. A pilot does not figure out their flight plan when they're on the runway and ready to take off. They've done that already. Same with a trucker. You've looked at your map, and when it's time to drive, you drive. And that's what trading is. Don't trust anyone else's homework. I can't emphasize this enough, and so I'm repeating it. Ultimately, you have to know all there is to know about your trade to hold on to it. Trade and be proud of the fruit of your own labor, not someone else's approach. Questions? Mike, are you still awake? You still here?
I'm here, man. You're doing good. I see a lot of people questioning your 50-50 probabilities, and it's been an ongoing discussion on the forum. You know, a lot of people can't wrap their head around basic coin toss odds. So you might want to elaborate on that a bit.
All right. So it's a long discussion. It's almost like that mini series that I was talking to you about. It would be one of the topics. But, you know, all I can say is people say, well, wait a minute, why would I trade a 50-50 probability when my homework shows that there's an 83% of one thing happening over another? How can people trade automated systems with a 50-50 probability? And what they're doing is, and I haven't read the questions, my screen's just too small. What people are confusing is the skew of a data set, the probability of a specific outcome over a group of trades or a data set. Just think statistically. So I have a data set, I have a population of 200 human beings, and they're either male or female. And within that population, I have 83% females. Okay? So I tell you, hey, Mike, here's a door. It's going to open, and an individual is going to come out of it. They're either going to be male or female. According to the population we just tested, which is separate from the population that's behind that door, it is, because we don't know what's next, right? Because, you know, trades just keep coming, new trades. So the population that we have tested in this area had 83% females. Who's gonna? I'm gonna whack you over the head if you guess wrong. Is it going to be a male or a female opening the door and exiting next? What's your answer? Anybody? You don't know. It's 50-50. No,
Yes.
you can't. People are saying female. No, it's not female. It's 50-50. You don't know if the person coming out of the door is going to be representative of the 83% you've tested or of the 17% you've tested. The fact is, the next person could change that 83 to 82% female, 18% male. And in fact, the next 20 people could change the odds from 83% female to 17% male and reduce it to 60% female, 40% male. You don't know. Okay? You don't know. The very next toss, that's what I'm talking about. That's all we care about, right? We don't care about all the trades we've taken. We can't replay those. But the very next trade is either a winner or a loser. And all you can do is stack the odds. So as I ask Mike, here, stand in front of this door, here's my bet, I'm going to whack you upside the head if you get it wrong. What he's going to do is say, okay, he's going to try to stack the odds against him because you know there's a danger of losing, right? I'm going to whack him upside the head. I won't really do it, Mike. I'm not violent. But he's basically going to say, okay, look, he's going to look around. He's going to say, all right, we're at a mall. Who goes to malls? Okay, most of the stores in the mall are female-oriented, so there's a good chance that there is going to be another female. I already know that I have 83% of females, but he's going to also look for clues as to why it could be male. And he's trying to figure out the odds. He's trying to figure out the odds. But his guess has a 50-50 chance. You can only get one of two things. You can either get one female or one male. And what people are arguing about here and with this discussion and what you see in the questions here, they're confusing the data set that has already happened with the very next instance of that data set repeating itself. You're looking, these are like the guys, and this is something we avoid doing in our trading systems. You go and you create a system and you optimize the crap out of it, and you tell everyone, oh, it tested out 92%, 92% winners, 92% winners. But you've optimized that system over that data set. But the fact is, the market doesn't necessarily have to repeat what it already has for that data set. It's constantly pricing in new information. Was there an Iraq war when that happened last time? Was there an oil shortage? Is there a revolution in Nigeria? Has Libya been taken over? Has that oil, you know, if you're trading oil, so many factors, you know. So people who love mathematics will always try to represent, I believe, the data set that has already occurred with an infinite number of trades that can be taken in the market. The fact is, the next trade, all you're doing is stacking the probabilities so that you have a better than 50-50 chance over a series of trades. But the very next trade, don't mistake the distinction. The edge on the very next trade can only be 50-50. That's a huge thing. So what does that mean? That means that you have to let go of that loss quickly. You have to allow enough chances so that your 83% female population, that statistic starts to reveal itself over time. So you got to let go of that loss. So risk is everything. Risk, 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 risk. If you hold on to that winner because you can't believe that with an 83% probability of a winner that you're in a loser and your chances are it's 83%, this one is also going to be a winner if you hold on to it long enough, you have not traded enough you have not taken enough trades going forward to generate a chance at that winner. And so the next step you have to take is the 50% that is a loss needs to outweigh, when it happens, when the winner happens, needs to outweigh that 50% that is a loss. Does that make sense? So if you trade a 1-to-1 probability on a random basis with a you know, your outcome is probably going to be negative on a random basis. But if you trade with a skew of 2-to-1 reward to risk, you have a much better chance of pushing the odds in your favor and getting a positive expectancy. This is a huge subject, and we can go over it, and a whole bunch of statisticians are going to come out with the dice and how it has 6 faces, and you know, how could you, you know, all that stuff. But
I know it's been a long discussion on the forum too, and we always get into some heated debates. But here's one thing that I like to think of: if I told you that the next words out of my mouth were either going to be the color red or the color blue, it doesn't matter if I've said red 99 times in a row. You still have a 50-50 chance that I'm going to say blue next time. So
Exactly, on the very next trade. And so what people are saying is, hey, wait a minute, according to my testing, and we build systems. We build systems. So we have to deal with this issue. You can't tell a client, hey, oh yeah, 92% chance to win, put all of your money in the system. No, you still have to tell the client that the information is hypothetical and that there's an equal risk of loss and gain on the very next trade. So you can't bet everything on the very next trade. You bet a small amount and then you cut it, because why do you take a loss quickly? Why does what's his name, Eckert, talks about cut the loser real quick. What you're trying to do is create the opportunity for that win to come along. As long as you're holding on to that loser, you're missing out. Not only are you taking a financial loss, you're taking an emotional loss to your emotional capital, which is the most important account you have within you, is your emotional capital account. But you're also missing the opportunity to go the other way or to take the next edge. Again, this is probably another 2-hour thing. We're not going to solve it here, but I only know 2 outcomes. Unless somebody can tell me there's a third, unless somebody can tell me that there's a third outcome to a trade, I'm going to stick with a 50-50, because that's been, after taking hundreds of thousands of trades, that's just a fact. And as long as you don't accept that you're trading probabilities, and you don't know what the trade outcome is going to be on the very, very next trade, I'm talking about the very next trade, unless you don't accept it, then you're in for a ride, I think, or you've cracked the code,
Well, people are asking about, does this mean there's no such thing as an edge? And I think that they're confusing what your long-term probabilities are over the next 100, over the next 1,000 trades. Then when you group all those together, you talk about edges. But for the very next trade, it's 50-50. Anyway, I see some other questions so that we don't continue down that line.
Okay.
Some people want to know why don't you use market delta, versus investor RT. Do you want to answer that?
Yeah, market delta is actually an awesome idea by Trevor. Trevor's a close friend of mine. Known him for when he first put out the product to my first prop shop, actually when I came to Chicago back in 2003 is when I met him. The footprint is really cool, but it's not relevant to me because it gives me more information than I need to make the next decision. What is that saying that they use? Information overload or whatever. There's actually a little saying that people say, floor traders especially say, where people start to put so much crap on their charts and look at so many things that there is, analysis paralysis, that you can't make a decision. Look, as a trader, I can trade and I can probably make money without even having a chart on, because I know myself. I understand the market, and I can read the book. So the information available on the footprint is cool. It's great, but I'm getting that information off the dome. So I'm not interested in the footprint information except in areas where I'm doing business. So if we're approaching a VPOC or a low volume node or something, and I know, hey, I need to take action here, I could either stare at the footprint or I could just look at the dome. And the dome will tell me how feverish the action is, and then the thing that the footprint doesn't give you or didn't give you for a while until he improved it. And again, it's an ingenious idea. It's just I don't need it. Is velocity, and then he started to represent velocity by providing, second charts and range charts in the footprint. But I already have that information in the dome. I see it for what it is. I see it for what it is. I don't need it. I'm just looking for my charts. I'm just looking for the big picture. Where am I going to do business today? And how are we? And then I always answer the 3 questions. I didn't cover these. These are very important. Market profile, or in any trading, you have to ask yourself, what is it? What has it done? What is it trying to do? And how good of a job is it doing in getting there? And in addition to that, I add when the market's choppy, what is more likely to happen, given the information we have right now, what we've done to this hour of the day, what is more likely to happen from here? Up or down? What is more likely? Give it a probability. 55, 45, 52, 48, 60, 40. And that's all I need. Remember, I scalped volume. And so for us, it was very simple. It's like, oh, it's not going down. Okay, buy it. It's not going up. Sell it. So I don't need all that much information. And the more information you have to break it down to very few things. A fighter pilot cannot sit there with a keyboard, and engage in battle and type stuff and pull up different charts. Oh, it's a MiG-29. Let me look. What size engine does that have in it? And that's what people do with their charts. No, a fighter pilot says, here's my approach. Here's his approach. This is what I have in my as armament, and these are the triggers, and this is what he can do. This is what I can do. I know my aircraft. Boom. I've got to pull a yo-yo. I got to pull a high G turn. I got to do this. I got to use flares. That's it. It's a specific set of tools to get the job done. You are a warrior as a trader. This is a business for warriors, high-performance athletes. I can't say that enough. You can't sit there and overthink it. The biggest traders in the pits, I used to go down the pit all the time on my bad days. The biggest traders in the pits couldn't care less about college, never went to college, never even finished high school. It doesn't take a genius. And that's why it's hard for me, when I was backing people, and I'm not right now, it was hard for me to justify bringing on, an engineer like myself. I'm an engineer by trade, by education. It's just, there's too much of this argument of 2 + 2 = 4. No, in trading, 2 + 2 = 3.2 today. It's 4.8 tomorrow. It's 2.2 the day after. And you have to be okay with the unknown. And almost everyone is not, especially engineers, because they've been taught that.
Can I ask you just a few basic questions? Like, do you always look for a certain risk reward before you enter a trade? Like, does it have to be 2 to 1, or you won't take the trade?
No, absolutely not. I'll take a 50-50. And I can manage the trade with size and turn it into a winner. It's about managing risk, which means managing yourself, and using trade management. You can you can throw a dart and make money. I can prove it. I have.
So you'll take it at 50-50 at 1 to 1, but you won't take negative. You won't go. You won't risk more than your target.
No, that doesn't make sense, because over time I will get caught, right?
And let me ask you, and I see some other people that were asking, just generally speaking, stop placement. Do you do anything like recent swing low minus a few ticks, or how do you decide?
That's another one that's big. It's a great question. One, I don't condone this, and this is not a trade recommendation. I don't use stops. But if you're trading remotely, I'm in Chicago. I trade out of the exchange until recently, and even now we have a very direct line to the exchange. I don't use stops. I stay proactive in my trade, but I suggest you use at least a disaster stop. Using a prior high plus 2 ticks, prior low minus 2 ticks stop is absolute murder. It's a sucker's play. You cannot base your trading plan on that. I'm sorry to say that. I'm sure many of you do it. But there are systems and there are traders out there who rely on that. When I used to trade the DAX super heavily, taking out the high or the low of the day was a huge trade. You hammer, you pick up as many contracts as you can into that high or low, and it would just explode as those stops get triggered, and it would come right back to where it was. And all those people who got stopped out are like, oh crap, look, it's going in my direction. So what do I recommend? I recommend sizing the trade so that your stop is safely away, and it's hard to do that on a small account. It's a complex subject.
Well, what about all the people that set stops based on their pain threshold? What do you have to say about that?
The market doesn't care.
Okay.
The market doesn't care about your pain. It doesn't care about what size account you have. If it's going to go to 1350, it's going to go to 1350. It doesn't care that 1348 is all you can take.
Right. It's just that I'm sure that you and I get a lot of the same questions, and these are things that I have to answer.
Sure. I've heard these before. Sure.
And again, I just have a few things that I'd like to hear
Sure.
your responses to. What do you think about psychology and its place in trading?
Huge, huge. Beware, beware the psychologist who doesn't trade, or beware the psychologist who's promising to turn you into an amazing trader. There are a lot of those, but psychology is key. I would say that if you invested 99% of your time on understanding yourself, your relationship with losses, your values, and your monkey, your emotions, just be aware. Like, one of the key things I try to do for my traders is, we do this coin toss exercise. There are like a set of 4 exercises they have to do. You have to learn to recognize your emotions. I'm never going to tell you, hey, ignore your emotions, or even worse, the advice that in the old days, the advice used to be, control your emotions. That's ridiculous. How could you control your emotions and trade at the same time? A pilot's going to feel adrenaline and is going to feel fear when he's in the fight. A warrior will always tell you that he's scared, even though he's fighting. Don't control it. Just be aware. Just tell yourself. For me, it's always the, uh-oh, all right, okay, no. I stop doing that, and then I'll get out of the trade, recompose, and get back in if I need to. Just recognizing when you're triggered is plenty of an edge psychologically. So focus on psychology. Steam Barter's great with that stuff. I mean, I've read all of his stuff, the Daily Trading Coach and Enhancing Performance and all that stuff. Great stuff. Trading in the Zone, great stuff. Now, can you build a trading plan around it? No, but it's great that you have an amazing plane to go to war with, but if you don't have a good pilot running it, it's worthless. And that's what psychology is. It's training that thing within you that gets emotional about money. Forget being attached to money. It's your biggest downfall. Give money away. I donate 10%. I always have whenever I could. And just take away the attachment to money, take away the attachment to anything. Attachment to anything causes suffering, and if you want to suffer, trading is an amazing sport for that.
Yeah.
Come here and try to make money trading for the money, and you'll be in for an awesome ride.
Yeah, I love Dr. Brett. He's a great guy.
Yeah.
What about here's a 2-for-1 question: all in, all out versus scaling in, scaling out, and what about?
You're really hitting the good ones.
What about averaging down? What about
I am, and this is the webinar we did yesterday for clients. I am a huge advocate of scaling out. Scaling out, all in, scale out is something that can be implemented by an inconsistent person and come out ahead still. It's possible. I'm not guaranteeing it, but it's possible. Scaling in is an advanced strategy. And the reason is because most people who scale in blur the line between I'm scaling in and I'm doubling down like a fool. They can't tell the difference. And if you don't have your ability honed down, to your ability to exit a loser without emotion, if you don't have that honed down, if you don't have that perfected, scaling down is going to be a problem for you. It's going to be a disaster, in fact. But I'm an all-in, scale-out guy, and if I see confluence, if I see an area where there's a VPOC, MCVPOC, and an LVN and a CLVN and all this crap all in one place, I will take 2 units, and that's a fair amount of size. And the S&P, I will take 2 units at different prices, and then I'll manage. And what I do is I scalp around my position to improve my theoretical average, which is what our trade analyzer software does to figure out for you, to improve the area of my stop. I don't use hard stops. I should have said that earlier. I don't use hard stops, but I do have a stop. I always have a stop. I've always got a predefined risk. I want to make that clear so I'm not taken out of context. But scaling in, scaling out is great because your job is always to take care of risk. And scaling out mitigates risk. I will do anything to mitigate risk, anything to mitigate risk, because over time I will make money.
I see some people asking about, how much money does it take? And I see people asking about risk size, 1%, 2%. Any thoughts?
If you're undercapitalized, you probably don't have a choice but to trade like 10%, to risk 10%, But generally, I have a chart, I think, in webinar 3, where I show that if you risked 1%, how many trades you have that have to hit your stop before you can stop trading, and what it is for like 2%, 5%, 10%. And it's exponential. It's an exponential relationship, right? It's to the power of X. And so the less you risk, the many more opportunities you have to trade. And the more you're risking, the much fewer. It's a very deeply parabolic chart. I don't have it here, but that question is very complex because it depends on how much money you have in your account and the fact that you're trading a leveraged product. Maybe I know some of you don't trade futures. You don't have a choice. You can't buy half a contract, or you have a guy who may trade a 50-lot unit, and that may only represent 1% if he hits his stop. So it's just a personal thing, but I think you need to keep it on the low side. I'd say max 5%. But do you put your stop at 5% on a $5,000 account? I think chances are you'll be within the harmonic rotation of the S&P or whatever product, and you're going to get stopped out more than you'll see a gain, on those particular trades.
Yeah, we agree.
Yeah. So yeah, I know my time is up, and I don't.
You got to figure out.
Oh, go ahead.
Sorry.
Take that money out of your pocket and put it in the trash can for a while. Just accept that it's gone, and just take the trade and manage the trade and honor your stop. Be it a hard stop 2 ticks above or below, it doesn't matter. Just honor it and accept the risk. Trading. I'll close with this. Trading is not meant to be a hold your breath endeavor. It's meant to be. It's meant to be a comfortable thing. I urge you to let the market come to you instead of you going to it. Don't chase things. And it's meant to be an adrenaline rush, maybe as soon as you get a fill, but immediately afterwards you should have enough confidence for you to calm back down and regain your field of vision. And know this about your psychology. When fight or flight is engaged, which is what will happen when you're attached to a particular trade, without knowing it, your field of vision narrows tremendously. So you cannot actually process information like you did when you were flat. And it's the closest thing you can imagine to this happening, to realize what it feels like, because most people are not aware of it, is the guy who's tipsy and is about to get into a car and drive home, and he thinks it's okay. Hey, no, I'm good. I only had 6 beers. I'm fine. See, I can stand on 1 foot. But what they don't realize, and this has been shown by making people drive around a cone at a certain level of alcohol, what people don't realize is, no, you can't drive. You think, your mind tells you can. You think you can, but you can't. And it's the same. When you put on a trade and it's driven by fear, you're in that same state of mind. There's no way you can analyze and make a decision on the fly while you're trading. And if you're fearful. So not doing your homework or listening to someone else's homework or not knowing exactly how to execute, when it's time to trade, it's time to execute, it's not time to think. Okay? And most people they just don't give that enough weight. And it's so important. It's just a tremendous part of trading is the fact that you understand yourself and your psychology and your shortcomings. And when the trade gets put on, you need to almost trade it like an auto strategy. Like we have an auto strategy feature in our platform where it just throws your orders out there. It'll move a stop for you or whatever. And you almost want to trade that way. Just plan it, execute it. Don't marry it, that sort of stuff. Anyway, I want to be respectful of everyone's time, and that's really why I started discussing doing a series with you, because I know this stuff is going to come up, and there's just a lot of information. But I want to let people enjoy their Saturday, and I need to get back to what I was doing.
Sure. So there's about 350 questions here, and I know that Anthony's been doing a great job answering a lot of them, but what is the best way for people to get in touch with you should they have any other questions?
Let me shoot back to the primary slide here. It's just go to my website. It's listed at the bottom, and just go to my website and use the Contact Us page. I can tell you that I'm really focused on our clients and those people who are really serious about trading now. It's just I've gone through 6,000 emails. I have about 2,500 more that I just will never be able to answer, and my time is really tough these days that I can't get to emails, and that's where Anthony is just a superstar. He's just an incredibly helpful guy. But I'll try to help out where I can, but in general, I'll try to do these talks. I really suggest you go to the website, you look at the blog posts, you look at the videos, and pick as much up as you can. I am someone who was lucky enough to be on the inside, who learned from some amazing traders, and I've done well myself. And I'm an open book, and I'm trying to take the mystery out of this and the secret sauce BS that's constantly sold to people. It's not about that. It's trading is a lot simpler than you think, and that's why my website's called Simplicity in Trading, and that's my philosophy. It's a lot simpler. It's about know thyself. That's what it's about, really, mainly. So I can't answer all the emails, but I do what I can. So don't take offense if you don't hear back.
All right, man. I really appreciate your time. Excellent webinar. I see some people asking, so here's one last question: Giants or Patriots?
Oh man, don't make me do it. I went to look. It should be the Bears. The question should be the Bears against the Giants or the Bears against the Patriots. It should be the Bears, but the Bears lost their quarterback this year. He was doing an amazing job. We had a really good chance. Yeah, Cutler injury. But I went to college in New York, so guess where I'm gonna go?
All right, man.
Yeah, it's a great team. Anyway, thanks so much for giving up your time to be here, and I want to wholeheartedly thank Mike for reaching out and making it a point to get this done. We've been talking about this for almost a year, and we got it done, and hopefully we'll talk again soon. Thanks so much for coming.
Yeah, we'll do it again. All right, thanks, guys. And I'll post the recording tomorrow, and I'll send it to FT71, and everybody can view it sometime tomorrow. Thanks, guys.